saying our co-founder and Chief Investment Officer, Damien Klassen, has been doing a huge amount of research into this over the last few weeks. And today he's here to share his insights. So Damo, welcome.
Thanks, Sam.
Excellent. Sorry about that. Yeah, so this is one of Damo's many areas of expertise. So I'm sure lots of listeners are going to get lots of value out of today's episode. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with me or one of the team. We are live every Thursday at 12:30 Sydney, Melbourne time. As you know, we just experienced a couple of technical difficulties, so you do get that with. And you can ask any questions that come to mind during the show, and we'll do our best to answer them as they come up. You can also follow us on your preferred podcast platform, as our show is available on all the majors. So, Damo, that's all the intros. I'll hand it over to you to lead us away.
Yeah, thanks, Sam. So, the key thing I wanted to run through, and I'll probably do a little bit of a quick overview as well on some of the latest developments, just in terms of Credit Suisse and issues with the banking sector. But the main thing I wanted to sort of delve into here is that there's different exposures you want at different times of the cycle, and some exposures are going to set you up for growth or coming off the bottom. Other exposures are going to set you up for going into downturns. Some of them work in some downturns, but not other downturns, and so that's the sort of the key part I wanted to try and get into, and in particular this idea that that value as well is something that's going to save you when you go into a downturn is not always true, and actually in my view is often is less true than it's only true on an ad hoc basis. And I think that's it's value certainly saved a lot of people in the tech the aftermath of the tech boom in the 2000s, and I think it gets too much of a reputation for saving you in terms of downturns. So, based on that one scenario, and it's had a lot of other scenarios where it hasn't saved you. But anyway, so I wanted to start with this idea that we're looking for sectors, we're looking for particular types of exposures within companies that are going to give us performance over different markets. And I just wanted to sort of go through some of these quant factors as well, and just a reminder for anyone who hasn't sort of listened in before, but even if you have, it's sort of worth just reiterating some of these. Is that so these are sort of mathematical models that are helping you generate performance. They don't always work, so they have sort of some of the more high frequency ones. If you're getting sort of 55-60% outperformance on it, that's actually giving you a 55-60% strike rate. That's actually really good, and that gives you a significant outperformance over the longer term. The other thing is there's this implicit assumption in there about non-reversion that you have to just keep testing. So basically, a lot of these factors are talking about you're putting stocks into certain categories and assuming that that's where they're always going to stay. And I'll jump into that in a minute in a bit more detail. But before we go on to that, the number one question you always need to ask is this idea that, are you selling insurance to the market? And more so now than ever before, in terms of where we are in the cycle. So if we're going to see that the Credit Suisse, what started, well, Credit Suisse had a dry run last year, and then sort of a few things short up, and now we've had a whole bunch more rate rises come through. We've started to see problems in the US regional banking sector that we spoke about in podcasts earlier on this week and last week as well. And now it's back to Credit Suisse having problems and potentially runs on Credit Suisse. If we're going into a banking crisis or some sort of credit crisis, then this idea about selling insurance to the rest of the market is really important. Given we've been going through this rapid rate rises, we've basically a faster set of rate rises than we've basically ever seen before. This idea of things can break and things can be, people can make mistakes, like we saw with Silicon Valley Bank in terms of how they're doing their hedging or whether they're doing the hedging at all. And that can make big changes within particular parts of the market. And so what I mean by this, are you selling insurance to the rest of the market, is there are certain strategies out there, investment strategies, where you get paid a little bit all the time. And so you go into that thing, and maybe it's something like selling a put option is you get paid. You go out there and sell a put option, you get paid for that. And it's a little bit all the time. Markets generally go up, so you're generally making that little bit every time, and then all of a sudden the market takes a big tumble and you lose a lot, and plus more. And the example I always use, probably strikes a bit closer to home, is say home insurance. It's very easy for me to sell home insurance to everyone around me, and it feels really good. I'm going to charge $100 a month, and I get $100 from this person and $100 from that person. I've got 20, 30 people all paying me this $100 a month, and I'm getting this, $2,000 or $3,000 flowing through, and it's like, hey, this is fantastic. Isn't this nice, easy money? And then all of a sudden somebody's house burns down, and I'm up for $500,000, and I'm like, oh, just a minute. I've just had 3 or 4 years of getting, $36,000 a year. I've got like $100,000, and all of a sudden I'm up for a $500,000 bill. And it's that idea with the market, is that there are particular strategies where you're basically being paid to take the risk that other people don't want to take, and it feels really good because you keep making that little bit of return all the time, but you've got to understand the risks that you're taking. So so as we're looking at these quantitative strategies, that's always the question we're asking within these. So I also spoke about this idea about mean reversion and non-mean reversion. So, and what I mean by this is there's sort of 5 big strategies or sort of key quant strategies that people will use. And then we'll delve into some of the sectors and countries and things like that at a later stage. But the 5 sort of key ones is momentum, which is like an idea that stocks that are going to go up keep going up, and stocks that are going down keep going down. It's what a lot of technical analysis is really based on, and the idea is that this is a no mean reversion. So stocks that are going to go up are going to keep going up, and vice versa. Low volatility is sort of it's an interesting finding, basically, that stocks that have this low volatility, so the share price doesn't move a lot when the rest of the market fluctuates, tend to outperform, which is actually the opposite to what some of the earlier theories and this theory about risk and return is. That if you're buying higher risk stocks, then you should get a higher return. Is this low volatility factor sort of shows that no, actually, quite often you're actually getting a better return by investing in low volatility stocks. And again, that's a no mean reversion. I'm buying low volatility stocks, going to stay low volatility. Growth means I'm trying to find the highest growth stocks. Quality means I'm looking for stocks that have got sort of margin of safety and earnings that are going to be stable and margins are going to be sort of high and stable. And then and both of those is, growth stocks going to stay growth stocks, quality stocks going to stay quality stocks. The final one, value, is a mean reverting series. So or you're making an assumption about mean reversion. So if you're buying value stocks, it's because you think they're cheap now and they won't be cheap in the future. And so it's a very different strategy to the other ones, and it performs differently. So a lot of the other ones are more consistent in the performance, whereas value tends to not make as much money or even underperform for long periods, and then suddenly make bucket loads of money for investors. And it's often like I'll talk about value as being a bit of a religion in a way, because there's a lot of people out there that they talk about it like a religion, and they've got sort of patron saints of people like Warren Buffett and others who they'll talk about saying, that this idea of value, just buy it, and as long as you believe, eventually it'll come good. Now, I'll go dig a little bit deeper into value in a minute, but I guess the big picture for me is, look, I like value. Value's great, but you can't use it on its own. And pretending that Warren Buffett does use it on his own, or these other people on his own is disingenuous, because they don't, like, it's a question about what Warren Buffett's all about: margin of safety. And what am I buying? I'm buying a good quality stock with a margin of safety. So I'm buying a good quality stock at a particular value. He's not saying I'm just going to go out and find the cheapest possible stocks I can find and buy those without regard to any other factor. And so that's where, there you go. So that's a sort of overview of the main factors we're looking at. Now jumping into, and I'll look at a number of different ways. There's a whole bunch of different ways you can cut these down and try and work out what's going on. I'm just going to focus in on some of these key factors, and I'm going to look at the S&P 500 market cap weighted returns. And what I'm looking at is basically if you bought the top 20% and sold the bottom 20%, what would have happened? So, for example, I've got some earnings quality figures up there. So basically, if I bought the 20% of the stocks with the highest earnings quality and sold the 20% with the lowest earnings quality, then this month so far I'd be up 6%. It's been a reasonable performer over the time frame. October last year it had a bit of a shocker, but it's been one of the better performing factors over the last few years, and that's one of the factors we're very much loading up onto it in terms of ours. Capital efficiency is a similar type of measure. We can see valuation at the bottom there has been up and down all over the place. And certainly when we look at the yearly data, that'll be even more apparent. And then the volatility one is probably the one I should have drawn out the most. This is a minimum volatility, and so that actually outperformed by 20% in January, but you'd lost pretty much 20% in the prior 3 months as well. So there's for the volatility is actually a low volatility. It's theoretically buying minimum volatility stocks. You're buying low volatility, but you've actually had a particularly volatile ride in that strategy over the last few months. And then if I jump to the annual data, it looks.
Hey, Damo, just quickly. So you said if you buy the top 20%, sell the bottom 20. Where does that come from? Do some indexes do that, or is that just sort of an arbitrary measure you've come up with?
It's a pretty common way that quant analysts will look at these as they're trying to evaluate whether these strategies work or not. And so you look at the return spreads between them. So these are overstating, I guess. What would usually happen is people would say, well, I'll buy a basket of stocks that are more minimum volatility, and I won't buy the market index. So I'll what's my performance going to be relative to the market index? Would be lower than what we're looking at now. So
Okay, cool.
So now I've got the annual data up, and this is very much showing. I'll highlight the bottom one, which is the valuation, and it's basically been either the worst performer or the best performer in pretty much every as you go year by year. It's had a number of sort of 20% plus drawdowns, the down years, and it's had the massive year last year in terms of 30%. Now I will dig a little bit deeper into that in a minute, but I guess the short version is you need to be careful of what you think you're getting when you're getting value. This is a pretty raw measure, and what it largely shows is energy stocks and to a certain extent banks, which are traditionally trade on those lower multiples. That's not always what I guess the theory would have is not that you're actually out there buying energy stocks and banks is not the theory behind value. The theory behind value is you're buying cheaper stocks on a relative basis, and so there's the question mark about whether some of these strategies, if you just put them in the raw numbers, what you're getting is what you're getting at the other end, what you thought you were going to get, and also that there's a lot of these factors where the definitions have changed over time. The accounting definitions have changed over time, and in particular for value, that's a big factor. And that means that stocks that are coming up value now are different to the stocks that were coming up value 20 years ago because the accounting standards have changed. And so, I'll go more into that in a minute as well. Some of the things, that I've got a little bit of a recap of some of the things that sort of I want to try and look out for is that there's a lot of stuff to talk about AI, and maybe just turn ChatGPT and point it at some stock market indexes or similar sort of artificial intelligence and say, tell me what to buy. The issue with a lot of the artificial intelligence stuff that I've seen, and I think most quant firms would concur with this, is what they tend to do is overfit. Is that there's they're very good. It's artificial intelligence very good in terms of saying, identify this. Is this picture of a cat? And you can tell it yes or no, and you can train it on big sets of data, and eventually, and you've got a right or a wrong answer. But the question for some of this is saying, well, okay, if I'm pointing all this, data and looking at it, and I haven't included in that data set that maybe Putin's going to invade the Ukraine, do I have a variable yes or a no? Is a major energy producer going to face sanctions? If I haven't got that in my factors, then I might be missing out on this, and so all these other factors are sort of combining to give me that answer. Or if I haven't got the temperature in Europe in there while that's happening, and seeing that it's particularly warm winter, and that means energy stocks are going to turn down on the other side, have I actually captured everything I need to capture? And so some of these models, if they're completely untrained or less well trained, you can end up sort of these things where you don't even know what's actually driving the model, and so it might be having to say, well, I'm buying companies that start with the letter B on Thursdays of the second Thursday of every month, and that's what's going to outperform, without knowing that that it just happened to find a random trend by looking in the past that's got no real basis for keeping on going. The other thing is, within quant, resources, utilities, financials in particular are difficult to run through quantitative models because they're quite different to others. So resources, if I use that, and energy in particular, is that quite often there's a factor where you're actually buying these stocks when they look expensive and selling them when they look cheap. And the reason why, in a sort of broad sense, is that they make their money from commodity prices. That's where they can control their costs a little bit, but in the end they've got this big sales item that they've got no real control over about how high that price goes. And so when the oil price hits $120, most analysts are looking at this going, well, that looks high. It's probably going to revert back to some sort of mean at some point. And so while this company's making these fantastic profits at the moment, I'm not going to pay over the top for it. So an ordinary multiple for resources stocks, you might be paying, say, 14 or 15 times the earnings. When it's at that's its average, at an average price. When the oil price is at $120, maybe you're only paying $3 or $4 per like a PE of 3 or 4 times your earnings for a lot of these stocks. And then vice versa, when the oil price falls to $30 or below, then people are actually saying, well, that I don't think that's sustainable. I think the oil price will go back up, and so therefore I'll actually, even though earnings are really low, I'm actually happy to pay a lot more for that earnings because I think there will be some reversion. And so and that doesn't fit the same way into quantitative models that a lot of other factors do. And then the other thing is, your manufacturing versus services. You can get different ratios sort of help for different companies. And so you just need to be careful that if what you're looking at is if you're looking at a company that's, say, got lots and lots of capital expenses and very little sort of ongoing expenses. So let's say it's you've got an oil rig and you're renting that oil rig out. So you've spent a whole bunch of money to buy this oil rig, and then you're renting it out and earning a return on that. You've got a very different business model to somebody who's, say, got a bunch of oil engineers that they're basically renting them out on an hourly or a markup basis, where you actually own very little assets, but you've just got these big variable cost of how many people you're employing, and then you're adding a margin and leasing these guys out to oil companies to do whatever they need to do. And so two companies, both in the same sector, both with vastly different business models, and and how you account for that and what different ratios show up can vary, and sort of making sure that you're making all these adjustments. You're not just using very raw sort of big picture numbers and going from there.
Excellent. So, Damo, I just want to share a message for our listeners about what else we do at Nucleus Wealth. So first and foremost, we're an active and passive investment manager. Our active portfolios use the insights shared in this podcast to construct and manage the Australian and international portfolios. The 3 tactical portfolios we offer hold combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation on these portfolios with the goal of protecting your capital in times of market uncertainty. We also have core portfolios that are purely international or Australian equity portfolios chosen from the MSCI World Index using our quality and value investment philosophy. Back to you, Damo.
Thanks, Sam. So I wanted to just dig through these 5 strategies and just to say, okay, well, look, if we're going into a downturn, or if you think that there's a no, let me put those two scenarios out there. One is we're going into a big downturn and it's quite possibly a credit crunch, and the other one is that we're going to go into there's a soft landing, sort of no landings type scenario, and it's time to get yourself ready for the next stage of the upcycle. And so, so within our portfolios, we're more towards the first, but I understand there's people out there who are bullish and have different view. So, if you're looking at a minimum volatility portfolio, theoretically, these things are going to perform better in big downturns. That's where you're going to pick up performance. They didn't do as well in 2008. He sort of went a little bit better than the market, but he still copped a lot of the fall. They did do a fair bit better, in the run up and better in the pandemic. The big issue you got to look at in terms of minimum volatility portfolios is that these tend to be very interest rate sensitive. So there's a lot of it is there's a question mark about how much the returns from minimum volatility has come from actually just falling interest rates over a long period of time, and then versus the actual the actual strategy. There's a question about whether you need to be looking at the volatility of the underlying earnings versus the volatility of the share price is important as well. So if I'm buying a stock that looks like it's a low volatility, but actually it's in a sector with very volatile earnings or is about to run into volatile earnings in the case of a recession, then these stocks can sort of fall out of these minimum volatility indexes and actually get sold down a fair bit, as it's coming out. And this can be a strategy as well that sort of needs to trade a fair bit. So it's not often it's not really a set and forget type strategy that you'd have. Momentum is another one. So this one's a very high trading strategy. Usually, so the returns look pretty decent over a longer period of time, but what these returns don't capture is a lot of these other strategies. You buy the stocks and you hold them, and you benefit from not having capital gains. There's sort of a lot of the momentum strategies are just trading constantly, and so what you're not seeing in these figures are your trading costs, which can be, if you're turning over your portfolio 4, 5, 6 times a year, can be meaningful in terms of your how much is taken off. And then the tax consequences of doing all that trading as well can make a big difference. And sometimes it might mean you, if it's depending upon what structure you're doing it in, maybe you actually get classified differently in terms of the tax department in terms of how much trading if you're following these strategies. But I think the main thing I'd be saying is, look, momentum strategies tend to work well in trending markets. If you start hitting sort of some sharp turns and what we've seen recently, where it's jumping from one period to the next, and swinging between which way is it going to go? These can be more dangerous and give you worse returns in those volatile markets. Value strategies. So this is probably the key one I want to sort of focus on over this, is that there've been, it's that idea I was talking about before about saying, well, how much of this is what you want to have exposure to, and how much of it is how much you've got exposure to because of accounting changes and because of the way it's constructed. So the idea is, when you look at, say, an MSCI, which is sort of like some of these official indexes of value stocks, they've got this big reliance upon book value. And what that means is that what they've put in their accounting standards as being their shareholders' equity is what they're comparing to the actual price. And so the idea is, if you look at the accounting earnings and you can say, oh, look, this thing's got $1 billion worth of assets, and the share price, if I add up all the shares and multiply them by the share price, I get $900 million worth of market value. Then I should rush out and buy that, because there's all this extra book value that's there. The problem is book value has changed quite dramatically over time, and I've spoken about this in a few other ones. I won't sort of bore you with the full details, but basically the accounting standards have changed, so there's a predisposition now to write things down in terms of book values and never write it back up again. Whereas 30 years ago, and a lot of the time periods where this long period of value is reliant on in terms of the back testing, is that the book value then was, companies would write the book value down, but they'd also write it back up. And so there was swings and roundabouts, but there was you would expect for a company to have a higher book value 20, 30 years ago than what it does today. And so and different sectors are affected differently. And so so the book value is not the same as it used to be. Some of the official measures don't use any cash flow, and they don't use a lot of forward earnings as well. Whereas if you look at the what some of the better performing factors have been, so I've got this MSCI value chart up, which is sort of showing the difference between different sectors within value. And the first one up there, the FCF, is free cash flow. So what I'm showing there is that if you're buying value and you're focused on cash flow, you've actually done way better than any of these other measures. So your book to value and all these other ones that are in there have been wildly volatile from one year to the next. So, some years you're down the most, other years you're up the most. But you can see that free cash flow to price has been a lot steadier than any of the other factors in terms of tracking. And so the idea, I guess, when you do want to follow a value strategy is, we'll work out what type of value strategy you're following. Is this a value strategy which is the textbook version with these accounting standards that have changed, and I'm just hoping that it's going to sort of all come back, or am I actually focused on a more cash flow base or something that I think is truly reflecting value within the business? And you tend to get a better return, or certainly a more stable return over that, and I think more in line with what you would expect a value strategy to deliver than what I think you're getting from value at the moment, which tends to be this very book value, and it means you're loaded up on energy stocks and banks is your big exposures. And the other thing actually with value though, for the non-energy, non-banks sectors, is that these are the stocks that actually tend to perform well when inflation is actually running a little bit hot. And the reason why is a lot of these stocks trade on quite cheap value measures, because they don't have a lot of a moat, or a lot of a business that is they don't have a lot of quality to the business in terms of they can't raise their prices usually and have clients stick. So if you took something like a tire manufacturer, there's a lot of them out there. There's if you're racing cars or doing something like that, you might be prepared to pay up for the one which you think is the best. But the reality for most people is, if there's 4 or 5 different name brands and one of them's 30% more expensive than all the others, then people are going to gravitate to one of the name brands that's cheaper. And so they don't have the pricing power to put up prices in ordinary times. In most recently though, companies have had that pricing power, so everyone's been getting away with it under the guise of, well, everyone else is putting up prices, and so I've been able to put up prices. Value stocks have really benefited from that. So despite their prices falling off, they have benefited from being able to raise their prices at this point in the cycle. Chances are though, they're the ones that are going to get hit the hardest if we go into this downturn. They're the ones which have got the prices where once people do start to compete on price, once their competitors all start to compete on price again, they've got the most to lose in terms of that. So using those tire manufacturers as well. If everyone has been putting up their price 5 or 10% per annum for the last little bit because there's been issues with supply chains and other things that they managed to get some price rises through, and then they didn't cut their prices, and they've managed to hold up and making quite good profits. If a downturn starts and they all start losing 5% of sales or 10% of sales, and then all you need is one or two to start saying, well, I'm going to try and make up that sales that I've lost by cutting my price, and I'll I've lost 10% of sales, but then I'm going to cut my price by 10% and pick up market share from everyone else. And that's ends up being a zero-sum game for everyone. That's capitalism. What we're expecting is that these companies will compete and push prices back down again to reasonable levels. And so the value stocks are the ones where you're most at risk of that happening. Whereas the quality stocks, which we'll deal with a little bit later, are the ones where you're expecting that they actually do have some more brand holding in there, and that people will continue to pay the higher prices, or they won't need to cut their prices as much. The other thing just with value is this idea that it's a tool, it's not a religion. Like, there's a lot of sort of, as I said, high priests of value out there who will tell you, come and invest with me and believe, and you just have to hold on, and value will come good, and this whole idea that value is all that matters, is that no, for me, value has to have another access to it, and we'll deal with how we deal with it. But you've got to be paying, like, you don't, if you're buying whatever it is, you're buying a new car. You don't just say, I'm going to buy the cheapest possible car, regardless of anything else. I'm just going to buy, regardless of reliability or the look or the oil, the fuel efficiency or anything. You don't just say, I'm just buying the cheapest. You actually go, no, I'm going to look at all the measures. I'm going to see what, reliability, and I'm going to see fuel efficiency and, comfort and all these other factors. And I'll work out what the trade-off is. And so it might be, I don't buy a Bentley for, $500,000. I might be happy with a Mercedes, or I might be happy with a Toyota, or whatever wherever you feel as if that quality versus value, the trade-off sort of hits that right point. And it's the same for stocks, is that it's not just about the price, it's about what you're getting for that price. And then keeping in mind as well that value is different to all these other factors, in that it's a bet on mean reversion, as opposed to every other bet is not on mean reversion. And so if you're buying value stocks, you need to have that idea that that's what's going to happen. And if value's just had a pretty decent run, like it has for a lot of stocks, a lot of value stocks at the moment, is that, okay, they've already mean reverted a bit. How much further have they got to go, or have they already gone too far, and actually the next stage is back the other way. Growth stocks are what you want to be. If you think we're in the part where it's the no landing or the soft landing scenario, and that growth is going to be, and companies going to be able to keep getting these price rises through, then growth stocks is where you want to be. If you're worried about recessions and you're worried about credit crunches and things like that, you definitely want to be out of growth stocks. The issue with growth stocks is, over a longer period of time, so the growth stocks have had a great run over the last sort of 5 to 10 years. If you go back further in time, their performance is nowhere near as good, and it was actually one of the worst factors over sort of longer periods up until sort of the early 2010s. And the reason why is not because these stocks don't grow earnings faster. They do grow earnings faster than the other ones. It's that people tend to overpay for it. So this is the key factor with whenever you're evaluating growth, is remembering that, I'm looking at a stock, it's got this great growth profile, and I'm buying at this nosebleed multiple. So I'm paying a huge price for something with the expectation that it's going to get this great earnings come through. Now, if the earnings aren't great, they're just really, really good, that stock can lose value, because it's priced for, growing earnings at 30% or 35% per annum for the next 5-10 years. Maybe growth only comes in at 25% per annum, which is a great growth rate, but it's not what's priced into the stock. And so what tends to happen with growth stocks is, when they do go X growth from that point where they're growing at 30-35% back to sort of 10 or 15, you get these big the amount people are prepared to pay for them comes back dramatically, and the earnings forecast come back dramatically, and you get sort of double whammy effect. But the bigger picture idea though is that if it is headed into a downturn, then growth will suffer the most, and we saw that last year in terms of growth was down almost 30% versus the market or MSCI World down around about 18, and so you can expect that trend to continue. Growth is where you want to be in terms of when you're coming out the other side of it. So as you're going into the upturn is where you want to be in growth. But if you're expecting recessions, you're expecting the higher interest rates to really start to bite at some point, then growth is definitely not the sector you want to be in. The other thing, just that if you're looking at some of the MSCI figures, say some of these official indexes. Again, you might not be buying the growth sector you think you are. We tend to want to look at the actual growth figures ourselves and see what's priced in and try and normalize the figures as much as possible. The MSCI growth indexes are reliant upon some technical issues, but I don't think they're reliant on an analyst figure that I don't think most analysts pay attention to, and they don't have any cash flow measures as well. And so again, you can sometimes, if you're just buying the raw indexes, you can end up with an index may not be as growth as what you think it is. And then the final one we've got is quality. Now, this is a sector where it tends to hold up well in downturns. And so it didn't do as well last year, but I think that's more of a factor of a high inflationary environment where all companies are getting these price rises through. I think as we go into if we're going into a downturn where earnings start to get hit, then quality stocks do tend to be the one that hold up the best in terms of that. Once again, the official indexes of quality that sort of get run. So MSCI run some quality indexes that most people use as the key benchmark. Again, there's problems with the makeup of these. They have they've got this big reliance on something called return on equity, and it's got the same problems that valuation does. The definition of equity has changed over time, and so there's this predisposition to having higher returns. And I've got an example of this MSCI quality for IBM, a couple of charts where I'm just showing the return on equity that IBM was officially earning on its. So the idea is you put equity into the business, that's your shareholders' equity, and then you're generating some sort of return. So ordinarily, if you're earning, say, 15% return on it, that's thought of as being pretty good. You can see the IBM ROE from 2006 to 2016 went from 20% to over 100% in terms of ROE, which is basically the assumption that if you had $1 invested in that business, then you're going to grow that dollar. Your earnings would grow by an extra $1 in the following year, which was quite patently absurd. It was more about IBM was not sitting there going, for every $1 we reinvest into the business, we will make an extra $1 in a year's time. Their returns were much lower when you look at the marginal rates, but it was the way they were doing buybacks. They were converting from a manufacturing company into a services company, and there was a whole bunch of different technical factors which basically meant that their return on equity, their official return on equity, based on their book values, just skyrocketed over that time frame, whereas their actual, their marginal returns were more in line with what you expect. And then from 2016, that they then sort of changed back and came all the way back down again, based again on sort of accounting changes and things like that was going on. So and I've also got the definition of what quality is for MSCI. So it's a quality score for each security is calculated by combining the Z scores of 3 Windsorized fundamental variables: return on equity, debt to equity, and earnings variability, which sound really good. Sounds quite official and all that sort of stuff. But what it can mean is Windsorizing basically means throwing away outliers, because I don't it's throwing my model out, so I'm going to toss them out. Whereas sometimes those outliers are actually really important. And the other thing is it's looking at Z scores, which is sort of like just try to measure how far away from the usual scenario things are happening. But it can be doing that on quite low numbers. Like it can be doing that on like 5 or 10 data points, which for anyone who's done any statistics is like, you're trying to create, you usually need like at least sort of 25 or 30 data points to actually get some idea about what we're looking at. Whereas these can be based on basically statistically insignificant sample sizes. Frequently they are. So again, the raw indexes doesn't always give you what you think you might be getting. And so then I just wanted to highlight, what we do for quality versus value, which is this idea that it's a trade-off. So we sort of put all our stocks on an index between sort of poor quality at one end and good quality at the other end. So poor quality is high on the y-axis and good quality is at the low end, and then everything from cheap on the left hand side of the axis to x-axis to expensive, and then we try and buy stuff under the curve. And the idea is that the discipline's meant to be that if you find really high quality stocks, then you can own them even though they get a little bit expensive. If they're really expensive, you want to sell them, but on average you want to try and buy those ones and then just hold them for the cycle. Whereas if you're buying sort of average quality stocks or poorer quality stocks, then it's fine to buy them if they're really cheap, but if they go up in price, then you have to start selling them. So if you think about stocks tend to move side to side on this chart based on the price, and it's very easy for people to it's very easy to buy an average quality stock, then see the stock double and think, oh, actually maybe it is better quality. It wouldn't have doubled if it wasn't really good quality stock. Versus a quantitative method that's basically saying, well, no, it hasn't really changed. It's still the same stock it was, still only average quality, and so if it's doubled, take your win and go and invest elsewhere. Whereas something that's on a really high quality stock, you might be happy just to hold on and keep generating those returns.
Nice one, Damo. So just one other quick message from our sponsors. So Nucleus Wealth is the first to offer passive direct indexing in Australia, which has been labelled ETFs 2.0. These are currently a huge and growing segment of the market in the US and Europe, and likely to follow here. The benefit of direct indexing is you directly hold each stock in your professionally managed account, as opposed to an ETF where you have one fixed security. Ours are similar in cost to many ETFs, and they allow you to customize your investment with our ready-made and bespoke ethical, sector, and asset class screens and tilts. We have around 80 to choose from, and this allows you to customize your portfolio to suit your preferences. An example of how you can use this is you can exclude fossil fuels and exclude Australian banks from your portfolio if you don't like these stocks or are bearish on those parts of the market. And then you could include a growth tilt or a quality tilt, or numerous other ones like lithium battery tilts or cloud computing, if you think they're well positioned to do well in the future. So that was just a quick message, and back to you, Damo.
Yeah, so then I just want to jump quickly through the stocks, and then we'll sort of talk about some of the sectors and how this sort of all fits together. So within these, I've pulled up the MSCI sectors because they're the sort of the main ones that most people look at in terms of these. So just to highlight what you're sort of getting. So if you're investing in value at the moment, if you look through that list, you're getting basically banks, energy, and healthcare. So anyway, I've spoken enough about the issues I think you've got within those, but keeping in mind that that top 10 makes up a pretty reasonable amount and is relatively indicative in most of these of what you get to follow. In terms of growth, you're getting all the names I guess you'd probably think you're going to get. Apple, Microsoft, Amazon's all the fangs. Tesla is in there. Meta or Facebook, Visa, Nestle sort of piled into that growth sectors. So lots of tech within there. In terms of quality stocks, it is a lot of the same names as what you're seeing in that growth portfolio. It actually gets a bit different as you start going further down the list, but yeah, it's actually not that different. you probably pick up a few more of the consumer stocks within the quality and consumer staples, especially once you sort of dig a little bit deeper. Momentum stocks, now these can change a lot. As I said, it's a high turnover strategy, but at the moment it looks a lot like a value portfolio. You still got lots of energy, lots of healthcare in that. Actually, of the top 10, everything's either energy or healthcare except for Pepsi. And then your minimum volatility is probably the most different at the moment. But again, you're getting plenty of healthcare within that. Lots of telecommunication stocks as well. And then the other one I just want to highlight, an ESG portfolio. So there's lots of ESG portfolios out there. We do it a bit differently in that we run the larger portfolios and then we let people come and say, well, what do you want to cut out of this? So whereas there's a lot of other places that sort of run ethical portfolios where they put a whole bunch of scores together and they basically go, oh, what companies score the best? And just wanted to highlight that you're getting stocks again that look pretty similar to what you're seeing in some of those other sectors, and they're not always they don't always fit with what everyone would consider to be an ESG portfolio. So Elon Musk has been running into a lot of problems with the SEC around corporate governance in Tesla and what he says and what he's not allowed to say, and he's been in court over what he's tweeting and things like that. But regardless of those, Tesla sits as a third largest stock within that index. Johnson & Johnson's going through a pretty decent sized court case around talcum powder and whether it's causing cancer, and that's potentially billions of dollars of payouts. But again, that's in the ESG sector. So it depends upon how you see all these stocks. We tend to think of ESG as being better as people can knock out sectors and stocks they don't want to see, and then you worry about the investment side for the other ones. So digging into sectors then is the other one I wanted to do. So if I've got the sectors, I'm just pulling up the historical. So this is a chart from Fidelity, just sort of showing that as you go through different cycles, this is what they're suggesting that you should be looking at in terms of sectors. Now, I haven't spoken a lot about the individual sectors and that over time in this same way, because I do look at it more about the factors that are involved, because I do think there's different parts of each of these that are very different in terms of how they're. You can get very different business models. You can get very different businesses within each of these sectors, but the idea is that if you're headed for that recessionary one, which is at the far right-hand side, you want to be out of financials, real estate, technology, industrial, and communication services. So basically, what we're looking at there is a lot of value stocks is what we're talking about getting out of, and some of the growth stuff in terms of the technology, and you see the industrial, which tend to be more cyclical. If you think you're into a rebound and things are going to take off, then you're into that. Almost the opposite. You're buying up on all those same assets that you didn't have. And so so for us, we do have a lot more of that consumer staples. We do have a lot more of the healthcare. Not as much in terms of utilities. A lot of the utilities do tend to be energy focused, but we've got, and that's obviously going through a pretty big transition, and it has its own issues at the moment. But where we can, we're buying utilities or telecommunications. And then a little bit on the consumer discretionary side, just given our take is that there's certainly some of the premium brands out there, the LVMHs and Monclers and ones that actually sell these really high value products where they have been relatively recession proof. We're sort of watching that quite carefully, but as long as we're seeing continued inequality, we sort of figure that this might be a chance to buy some of those ones or hold some of them at prices which you might not see in a traditional market. So yes, so that's a sort of rough guide. In terms of countries, I probably won't go fully into the countries. Actually, my main point on the countries I just wanted to make was that countries are often in terms of when you're looking at large cap stocks, that can be misleading in that a lot of the large cap stocks you're looking at really are global stocks. So if we took Australia as an example, sort of excluding the banks, once you start looking through the big companies, most of them tend to be global market performers. They're more aligned to what's going on in the world. So BHP, Rio, all that resources sector is dependent upon world growth. If you look at a company like CSL, its business, whether its business in Australia goes up 10% or down 10%, really doesn't make much as different as what happens overseas. Brambles Computer Share, you can go through the list of all the companies that are sort of very much reliant upon overseas exposures as much as Australian, and that's true in a lot of other countries. So where I'm getting to is that an investment in Australia, for example, what matters as an investment in Australia as a broad sector is that you're getting heaps and heaps of banks and you're getting heaps and heaps of resources relative to what you get in the rest of the world. So you're sort of ending up with half your portfolio in sort of two sectors, whereas around the rest of the world, that might be 10% of your portfolio or 15% in most other markets. So and different countries will have sort of similar biases towards one sector or another sector. So in small caps that can help if you're looking at small caps within sectors, but once you're looking at large stocks and multinationals, I tend to find that the country comparisons not that useful in terms of looking at performance. Much more useful to look at the sector by sector performance.
Excellent. So now we have our question of the week. This is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, which investment strategy is your preferred for 2023? So feel free to post your thoughts, engage with us and some of the other viewers over the coming days. And Damo, we've had an excellent question come in from Jude. So they're saying, I'm with Nucleus for the long term, 5 years plus. Is Nucleus decision-making based on 5-year timelines or less? And can clients have a long-term setting, or is 5+ years too uncertain for a time horizon?
Yeah, good question. So look, there's two different types of settings you have for your investments in terms of your assets. Like what are you buying in terms of bonds versus equities? One setting is what we call a strategic allocation, which is, okay, say you're a young investor, you're happy you're relatively risk tolerant, so you're happy to deal with the ups and the downs, and you just got to go, look, I'm just going to buy 70, 80, 90% of equities or whatever the right one is for you, and that's it. I'm just going to hold that forever. And so, and maybe as I get older, I might start winding it back a little bit. And so we can do that, and we do that for a number of different clients. What we prefer to do for most clients is run it as what's called a tactical. So what we'll do is we'll get your own strategic. So for some investors, that might be 80% equities. For other ones, it might be 50% equities. And then we'll vary the equities holdings around that based on our outlook for the market. And so what we'll do is, at the moment, for example, if you've got an 80% is your benchmark, we're probably holding closer to 50%, and we've got 30% extra cash waiting for the market to pull back. We can tip that in and then take the next leg up. If your benchmark was 50%, maybe we've got 30 or 40% maybe 30 or 35% equities in your portfolio with that same idea. We want lots of cash ready for you to invest, if the market pulls back. And the idea behind that is what we're trying to really do is limit. We're trying to lean into the cycles and limit the downside. So give you some downside protection, and then with the view that, even if you end up in the same place, we're targeting to end up in a better place, and so far that's been true in terms of the growth portfolio. Is that if over that cycle we can take off those big falls you get and then rise up, and that sort of gives you a much better investment outcome over that time frame. So in terms of tactically, 5 years is too long. Yeah, absolutely. Strategically, it's fine. You just sort of throw it in and you say, well, I'm just going to be aware of the fact that some years I will be up 20 or 30%, other years I might be down 10 or 15. Whereas the tactical is more about smoothing out those the extremes.
Nice one. I hope that helps, Jude. So, yeah, those are all the questions for now. So if you enjoy our content and want us to continue to make more, please subscribe to our YouTube channel now and click the bell below to make sure you don't miss out on any new content. Don't forget to like the video now. And if you know anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. If you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content or subscribe on our homepage for our weekly Nucleus news and investment insights. We do put out a lot of other articles and videos in addition to this podcast. Damo just put out an article yesterday on inflation, for example. And of course, you can follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next week. Bye for now.